it's obvious what Moody is saying. There is a template which some of the rating agencies they follow, and the template is that India's GDP growth is contracting and fiscal deficit is going to go higher and disinvestment targets are not going to be met. So if you are looking at ratings which are a function of government's ability to generate revenue and the ability to, in a sense, control on the fiscal deficit, on both the front growth has contracted, then you have a serious shortfall which will come out this year, and then there is every reason to believe that disinvestment, which was considered to be a done deal at least in this calendar year, will not happen. So if you put all these factors together, and since rating agencies are committed to follow a template based on evidence, based on data, based on forward-looking indicators, downgrade was coming. Now the point is that will this kind of a downgrade lead to a mass exodus towards India, or will this be change in India positioning in the debt market, or will the foreign capital go haywire? I don't think so. I mean, right now we are not in this kind of an environment where rating agencies clearly, or ratings are clearly the beyond and end all of what institutional investors have to share or what institutional investors currently are doing. Everyone knows that these are not normal circumstances. Well, while rating agencies will do their bit in order to stick to the template, I don't think that would be the only condition which in a sense would be the driving factor for flows at least into the debt market and into the equity markets.
Okay, let's get you a comment from Moody's on India. We spoke with William Foster late yesterday evening post the downgrade coming in, and he talked about what policymakers would find challenging in terms of mitigating risks of low growth. Listen in.
The negative outlook means the risks are that in the future there could be a lower rating, there could be another downgrade. But to be very clear, what would happen since we had upgraded the credit from Baa3 to Baa2 in 2017, that was based on expectations that the series of reforms that the government had put forward, for example, GST, Insolvency and Bankruptcy Code, the FRBM, so the Fiscal Responsibility and Budget Management Act, that all of these things, along with measures to improve the overall environment for doing business, would result in stronger, higher growth that's sustainable in the future, along with a downward trend in deficits and the debt burden, which is, from a sovereign ratings perspective, one of India's biggest weaknesses relative to the peer group. And that's how we look at India relative to peers. And unfortunately, what we've seen since then is, despite many of these reforms and announcements being pushed forward, they've had very little impact on the economy. They've had very little impact on growth. We've seen actually fiscal deficit targets continue to slip. And in fact, the debt burden has gone up. It's risen instead of fallen. And on top of that, we've also seen broader challenges in the financial system that had not been anticipated at the time. So not just within the public sector banks, but spreading into the non-bank financial system, and more recently, even with private sector banks, which is an additional headwind to growth. So all of that has really put a lot of pressure on India's economy and credit profile more broadly. And fundamentally, it's now has a weaker credit profile than it had when we had upgraded the credit, and it's more in line with the Baa3. The risk moving forward, and that's why we have a negative outlook, is that things could continue to deteriorate. Growth could continue to slow structurally to a much lower rate than in the past. Deficits could continue to slip. And if the financial system does not improve and stabilize, that would further potentially exacerbate these growth risks and increase the contingent liabilities for the government, potentially costing more and adding to the fiscal burden.